Most people think the return to office debate is about productivity. Are remote workers less efficient? Are people more creative in person? Do managers just want to see employees sitting at desks again? That is the public conversation, but over the past few years, something strange started happening. Companies with strong remote performance began ordering workers back anyway. City governments quietly supported those mandates. Commercial landlords became louder and more political. Transit agencies suddenly cared deeply about office attendance. And financial analysts started warning about risks most employees never even think about. At first glance, these groups seem to have nothing in common, but they are all connected by one uncomfortable reality. Modern downtown economies were built on a single assumption that millions of people would travel into city centers every single day. And when that habit broke, something much larger than office culture started shaking underneath the surface. Because remote work did not just change where people answer emails, it disrupted an entire economic machine, one built around the daily commute. Think about what actually happens when workers stop showing up downtown every morning. Coffee shops lose foot traffic, restaurants lose lunch crowds, transit systems lose riders, office towers lose tenants. Buildings lose value, and suddenly, banks, pension funds, and city budgets start paying very close attention. The worker sees flexibility. The financial system sees something else entirely. Today, we are going to unpack the hidden economic forces behind the return to office push and why this debate may have far less to do with productivity than most people realize. Because the office is not just a workplace, it is one of the load-bearing pillars of the modern urban financial system. Let's start with the story we hear most often. Executives say workers need to return for collaboration, innovation, mentorship, culture, creativity, and those famous spontaneous hallway conversations. And to be fair, some of that is real. A junior employee sitting near experienced colleagues genuinely can learn faster. Some projects move better in person. Certain creative work is simply harder through a screen. But if this debate were purely about productivity, companies would probably behave very differently. They would measure output rigorously, compare team performance across different models, and tailor office policies around specific business needs. Instead, many mandates are surprisingly blunt: 3 days a week, 4 days a week, sometimes full-time, often applied almost uniformly across departments doing completely different work. And that raises an uncomfortable question. Are companies solving a productivity problem, or are they trying to stabilize something much larger that depends on workers physically returning downtown? The answer is probably both. But the second part is the one almost nobody says out loud. To understand this story, you need to stop thinking about office towers as ordinary buildings. To most workers, an office is a place with desks, elevators, meeting rooms, and bad coffee. To investors, an office tower is a financial asset. Its value depends on future rent depends on tenants. Tenants depend on whether companies still need office space. And companies need office space only if workers actually show up. That is the hidden chain underneath the entire system. And so when remote work reduces demand for office space, it does not simply create empty desks. It changes the expected future income of entire buildings. And when expected income falls, the building itself becomes worth less. That sounds abstract. The consequences are not. Imagine owning an office tower projected to generate reliable rental income for the next 30 years. Then tenants start downsizing, renegotiating leases, quietly moving into newer buildings. Suddenly, the future cash flow supporting that asset looks much weaker. And if it weakens far enough, refinancing becomes difficult, sometimes impossible. That is why remote work became more than a workplace trend. It became a financial shock. In the widely cited paper Work from Home in the Office Real Estate Apocalypse, economists Arpit Gupta, Vrinda Mittal, and Stein van Nieuwerburg estimated that New York office values could decline dramatically in the long run because remote work permanently shifted expectations around office demand. That was the real turning point. Investors suddenly had to confront a question that barely existed before the pandemic. What is an office building actually worth in a world where the office is optional? The slow-moving train wreck. This crisis does not look like a Hollywood disaster movie. There is no single day when every office tower suddenly collapses. Instead, the process is slow, uneven, and surprisingly quiet. Leases expire gradually, property values adjust slowly, banks extend loans, landlords wait, cities hope the market recovers. Everyone buys time. That is exactly why economist Stein von Neuerberg described the situation as a slow-moving train wreck. The office market is not collapsing all at once. It is repricing itself, quarter by quarter, lease by lease, floor by floor. Now, to be fair, parts of the market have stabilized. Premium office space in top locations continues attracting tenants, and vacancy rates in some cities have improved. But those headline numbers hide a widening split inside the market. The newest, best located buildings are often surviving, sometimes even thriving. Older, less desirable buildings are not. This pattern is often called a flight to quality. Companies may need less office space overall, but the space they keep is increasingly concentrated in premium locations. The pain is not evenly distributed. The trophy tower may survive. The aging office building across the street may become financially obsolete. And this is where the story gets much bigger than landlords. Most office buildings are financed with debt. Owners borrow against the property, use rental income to cover interest payments, and refinance loans as they mature. For decades, this system worked beautifully. Interest rates stayed low, office buildings looked safe, downtown demand seemed permanent. Then two things happened at once. Remote work weakened office demand, and surging inflation pushed interest rates sharply higher. That created a brutal double shock. Lower property values colliding with far more expensive refinancing. Suddenly, hundreds of billions of dollars in office debt were sitting on top of buildings that might no longer be worth what investors once assumed. And for years, many banks avoided recognizing those losses immediately by extending loans and waiting for conditions to improve. In commercial real estate, this became known as extend and pretend. The logic was simple. Landlords hoped workers would return. Banks hoped rates would fall. Cities hoped downtown activity would recover. Everyone hoped time would solve the problem. But time does not fix structural change. It only delays the reckoning. That is why office attendance suddenly carries financial weight that most workers never see. If workers return, companies lease more space. If companies lease more space, buildings generate more rent. If buildings generate more rent, landlords refinance more easily. If landlords refinance, banks avoid losses. That is the hidden financial chain underneath the return to office debate. But here is the problem. Office towers were never just office towers. They were anchors for entire downtown ecosystems. Healthy downtowns generate property taxes, support restaurants and retail, fund transit systems, fill parking garages, attract hotels, and sustain thousands of local businesses. A half-empty office district weakens all of them simultaneously. And this is where the story becomes politically charged. When one person chooses remote work, it feels like a personal lifestyle decision. When millions make that same choice at once, entire urban economies start restructuring. The worker sees a saved commute. The coffee shop sees fewer customers. The transit system sees a structural revenue gap. The landlord sees weakening demand. The bank sees refinancing risk. The pension fund sees asset repricing. Different groups experience completely different versions of the exact same economic shift. And because property values adjust slowly, the financial stress can stay hidden for years before becoming fully visible. Here is one of the least understood parts of this story. When people hear commercial real estate investor, they imagine billionaire landlords. But office buildings are also indirectly held through pension funds, insurance companies, real estate investment trusts, and massive institutional portfolios. That means office losses do not stay with a single landlord. They spread slowly through retirement systems, through insurance portfolios, through municipal finances, and eventually into the savings of ordinary people who never once thought about commercial real estate. This is part of the hidden political economy behind return to office mandates. Empty offices hurt landlords first. But if losses spread far enough, they eventually affect banks, insurers, city budgets, and pension systems. That creates pressure from many directions, not just corporate boardrooms, to stabilize office demand. Companies themselves are not neutral players in this story. Some signed long-term leases they cannot escape without enormous penalties. Some own headquarters or campuses outright, physical assets that require occupancy to justify their existence. Others spent billions redesigning offices, building amenity-rich campuses, and expanding downtown infrastructure right before the pandemic changed the rules of the game. If employees stop showing up, those investments suddenly become much harder to justify. There is also a signaling effect. A busy headquarters communicates momentum, discipline, and institutional strength. An empty office communicates the opposite, even if the company itself remains highly profitable. And beyond internal incentives, large employers sometimes face quiet pressure from city governments eager to stabilize downtown tax bases. So a return to office mandate is not always just an HR decision. Sometimes it is part of a broader economic stabilization effort, even if nobody describes it that way publicly. For decades, modern city economies were built around concentration. Urban centers created enormous advantages by clustering workers, finance, universities, restaurants, and infrastructure into dense physical spaces. Economists call these agglomeration effects. In simple terms, people and companies often become more productive when physically close together. Ideas spread faster. Workers change jobs more fluidly. Industries grow around each other. But technology gradually weakened one part of that model. Cloud software, video conferencing, remote collaboration tools, and increasingly powerful AI made many forms of knowledge work far less dependent on physical proximity. The pandemic did not invent remote work. It forced the largest real-world remote work experiment in history, and once millions of workers experienced life without a daily commute, many of them simply never wanted to go back. The old equilibrium broke. That does not mean cities are doomed. Far from it. Cities still offer talent concentration, cultural infrastructure, universities, airports, healthcare systems, and human networks that remain extraordinarily valuable. But downtown business districts built primarily around the 5-day commuting model now face a genuine structural challenge, not a temporary one. That is exactly why many cities are now trying to convert older office buildings into apartments, laboratories, hotels, and mixed-use neighborhoods. The goal is no longer simply restoring the old downtown, it is building a new one. And that brings us to the central contradiction at the heart of this entire debate. If office work is genuinely more productive, companies should eventually be able to prove it clearly through output, retention, revenue, and innovation. If remote work is genuinely more efficient, society may need to accept that many downtown assets will permanently lose value, and someone will have to absorb those losses, but nobody wants to absorb them. Workers say, I can do my job from home, why should I sacrifice hours commuting? Landlords say, if workers never return, our buildings lose enormous value. Cities say, if downtown weakens, tax revenues, local businesses, and public services all suffer. Banks say, we need these loans to keep performing. Pension funds say, we need stable long-term returns, and companies sit uncomfortably in the middle of all of it. That is why this debate feels so emotional, because it is not really about where people work. It is about who absorbs the losses from a changing economic system. So the next time you hear a CEO announce that employees need to return to the office for collaboration, culture, and creativity, listen carefully. That may be true, but it is almost certainly not the whole story. Behind the language of teamwork and innovation sits an enormous financial structure that most workers never see. Office towers support loans. Loans support banks and bondholders. Property values underpin city budgets. Commercial real estate anchors pension portfolios, and daily commuting sustains entire downtown ecosystems. Remote work accidentally exposed just how much of the modern urban economy was built on one deeply ingrained habit. Millions of people traveling to the same place at roughly the same time, 5 days a week, without ever questioning whether it was necessary. The hidden financial reason companies want workers back is not simply that remote employees are unproductive. It is that empty offices threaten a chain of financial obligations built during a completely different economic era. The real question is no longer whether remote work works. The real question is who pays for the world it replaced.